Welcome to Burns Hustles, where we turn side hustles into cash. Have you ever wondered how investing works or how to get started? Well, you're not alone. Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. It's an essential part of financial planning that, when done right, can significantly boost your wealth and provide a safety net for the future. Now, imagine your investment portfolio as a shopping basket. It can contain different types of financial products, each with its unique set of characteristics and benefits. The key components are stocks, bonds, mutual funds, and ETFs. Stocks represent ownership in a company. Bonds are essentially loans you give to an organization. Mutual funds pool money from multiple investors to invest in a diversified portfolio. And ETFs, or exchange-traded funds, are a type of fund and exchange-traded product. Investing can seem complicated, but understanding these fundamental concepts is a great start. Now that you know what investing is, let's dive deeper into each component. Stocks, often known as shares, represent ownership in a company. When you purchase a stock, you're essentially buying a piece of the company, becoming a shareholder. Fascinating, isn't it? You're not just putting your money into a company, you're becoming a part of its journey, its success, and yes, its failures. Now let's delve a little deeper. How do stocks work? Well, companies issue stocks to raise money for various purposes, such as expanding their business, launching new products, or repaying debt. As a shareholder, you're entitled to a portion of the company's earnings, usually distributed as dividends. You also get voting rights at shareholder meetings. But remember, owning stocks also means you're sharing in the company's risk. If the company doesn't perform well, the value of your stocks could go down, or in the worst case scenario, become worthless. So, where do you buy these stocks? Welcome to the stock market, a bustling platform where buyers and sellers trade stocks. The price of a stock in this market is determined by supply and demand. If a company is doing well, more people want to buy its stock and the price goes up. If it's not doing so well, the demand decreases and the price falls. Now, before you dive into this exciting world of stocks, here's a word of caution. Investing in stocks is not about making quick money, it's about making informed decisions. It's crucial to research and understand the company you're investing in, its business model, its financial health, its competitive position in the industry, and its future prospects. You're investing in the company's future, after all. Also, it's worth mentioning that stocks have the potential for high returns, which is why they attract many investors. However, they also come with high risk. The stock market is volatile, and prices can fluctuate significantly in a short period. So, stocks can offer high returns, but come with high risk. Now let's look at a safer option. Bonds. Bonds, unlike stocks, are more about lending than owning. Now imagine this. You're lending money to a friend, and in return, they promise to pay you back with a little extra on top. That's the basic principle of a bond. In the world of finance, when you buy a bond, you are effectively lending money to an entity. It could be a corporation or a government. In return, this entity promises to pay you back the principal amount at a specific date, known as the maturity date, along with regular interest payments along the way, also known as the coupon. The beauty of bonds lies in their reliability. The issuer of the bond has a legal obligation to pay back the money they owe you. This makes bonds a safer investment compared to stocks. Because with stocks, you're buying a piece of ownership in a company, and if the company doesn't do well, there's a chance you could lose your investment. But it's not all sunshine and rainbows with bonds. The safer nature of bonds also means they generally have lower returns than stocks. Think of it as a trade-off between risk and return. With bonds, you're getting lower risk, but also lower potential returns. So you might wonder, why would anyone choose bonds? Well, because not everyone has the same risk appetite. For some, the steady income and lower risk associated with bonds can be quite appealing, especially if you're nearing retirement, or if you're saving for a specific goal and can't afford to take too much risk. It's also worth noting that the value of bonds can fluctuate based on interest rates. When interest rates rise, bond prices usually fall, and vice versa. But don't fret, even if the value of your bond decreases, as long as the issuer doesn't default, you'll still get your principal amount and the promised interest. Bonds are a safer bet, but for a more diversified approach, let's look at mutual funds. Because remember, the key to a successful investment portfolio isn't about putting all your eggs in one basket, but rather about spreading your investments across different types of assets. And that's where mutual funds come into play, but that's a story for another scene. Mutual funds and ETFs, in simple terms, are a collection of stocks and bonds. Now, isn't that fascinating? It's like having a mini stock market in your pocket. But let's break it down a bit further. Think of a mutual fund as a big basket. This basket holds a variety of investments, be it stocks, bonds, or other assets. When you buy a share of a mutual fund, you're buying a piece of everything in that basket. This is where the magic of diversification comes into play. Instead of putting all your eggs, or rather all your money into one company's stock, you're spreading it out across multiple companies, sectors, and sometimes even countries. This can help to manage risk and potentially smooth out the bumps in your investment journey. Now, let's turn our attention to ETFs, or exchange-traded funds. Much like mutual funds, ETFs also hold a diverse range of assets. The key difference: ETFs are traded on exchanges like individual stocks. This means you can buy and sell them throughout the day at fluctuating prices, unlike mutual funds, which are priced only at the end of the trading day. So, why should you consider mutual funds or ETFs? Well, it's all about that buzzword we mentioned earlier, diversification. By spreading your investments across a wide array of assets, you can help cushion the blow if one sector takes a hit. Plus, these funds are managed by seasoned professionals who have their finger on the pulse of the market. But here's the kicker. Mutual funds often require a minimum investment, which might be a hurdle for some. ETFs, on the other hand, have no such minimums, making them a more accessible option for many investors. However, it's crucial to remember that while mutual funds and ETFs offer diversification and professional management, they're not immune to market fluctuations. Like all investments, they come with their own set of risks. Mutual funds and ETFs are great for diversification, but remember, all investments come with some level of risk. The world of investing is a balance of risk and return. Now, let's break that down. Risk, in the context of investing, refers to the likelihood of your investment decreasing in value. Return, on the other hand, is the money you make from that investment. The higher the potential return, the higher the risk. It's a bit like a seesaw. As one side goes up, the other comes down. But here's where it gets interesting. Diversification, or spreading your investments across a variety of assets, can help manage this risk. Picture it as a balanced diet for your investment portfolio. Just as you wouldn't only eat potatoes for every meal, you wouldn't want to put all your money into one type of investment. By diversifying, you're spreading the risk. Some investments might do well, others might not, but overall, you're less likely to lose all your money. Now let's talk about the power of compounding. It's a simple yet powerful concept. Essentially, it's earning interest on your interest. Let's say you invest £100 and earn 10% interest in the first year. That's an extra £10. Now in the second year, you're earning interest not just on your initial £100, but also on that extra 10. Over time, this can significantly boost your returns. It's like a snowball rolling down a hill, getting bigger and bigger. However, keep in mind that while compounding can accelerate your returns, it can also amplify your losses if your investments decrease in value. That's why understanding and managing risk is so crucial. In the end, remember this. Investing isn't about getting rich quick. It's a long-term game. The aim is to gradually grow your wealth over time. It's about patience, persistence, and understanding the balance between risk and return. Investing is a journey, not a destination, and understanding these basic concepts can set you on the right path. So, we've covered a lot of ground today on the basics of investing. We started with stocks, the shares of ownership in a company. They can provide high returns but come with higher risk. Then we moved on to bonds, a safer bet, where you lend your money to a company or government for a fixed return. We also talked about mutual funds and ETFs, which allow you to spread your investments across a wide range of companies, thereby diversifying your portfolio and reducing risk. We delved into the concept of risk and return and how they are inversely related. Higher the risk, higher the potential return, and vice versa. And finally, we touched on the power of compounding. It's the magic that makes your money grow exponentially over time, especially when you reinvest your returns. Remember, investing is all about making your money work for you, So go ahead, start your investing journey today.